Hello, traders. I'm going to take you back to a week in December 2018. This was a week that I almost quit trading. Now, losing money is part of trading, and I get that, but losing yourself is a choice. You see, I didn't just lose a lot of money that week. I shattered my confidence, and the only thing that brought me back was a boring, rigid safety net. You see, most traders think they need a better strategy to win. They think if they just find the perfect entry, the profits will follow. But I want to know what my risk is. I want to know that my downside is protected before I ever think about the upside or the amount of money I can win. Because context is king, and the context of my early trading career was chaos. Today, I'm going to walk you through the exact risk management plan that saved my trading account. This isn't about getting rich quick. That is when you lose everything. This is about the specific rules, the hard stops, the position sizing, and the psychological boundaries that turned my trading from a gambling addiction into a business. I want to take you back to the day that it really began for me. The VIX was spiking. The day was December the 14th, 2018, and I was convinced that I saw a setup. I entered several call positions, all in the tech sector. I didn't have a clear plan before entering them. I just thought that I knew what the market was going to do next. Now, had I been more educated and smarter as a trader, after that first day, I would have just taken my loss and moved on. But I didn't do that. What did I do? The next day, I came in convinced the market was going to recover, and it just kept going down. So rather than taking my loss, I doubled down on my positions. Now I am overly allocated all in one area of the market, and I'm convinced that this is going to be the time the market turns around. No, I got up the next day, watched as my profits from the whole year were slowly slipping out of my grasp. Then a fourth day, still watching as price continued to go against me. I wasn't able to stop out, not because I couldn't, but because my pride or my ego, my need for being right, it wouldn't let me stop out. No, then I did the unthinkable and I doubled down again, convinced that this was the point the market was going to turn around. But long story short, it didn't. And for another 2 days, the market continued that downward track. I had given up over 6 months of profits in just 6 days. I was devastated. You see, trading without a risk management plan, it's just gambling with a fancy interface. And the house, which is the market, always wins if you don't have rules. I almost walked away from trading entirely after that week. I closed my laptop. I didn't look at a chart for several weeks. But during that time away, I realized something critical. I didn't need to be smarter. I needed to be more disciplined. I needed a plan that protected me from myself. When I came back to trading, I adopted a new mantra: boring is better. You see, excitement in trading usually costs you money. If your heart is racing when you enter a trade, you are sized too big or you don't have a plan. I started to treat my trading like a business operation. A business doesn't just hope for profits, it manages expenses. In trading, your losses are your operating expenses. You want to keep those expenses low and predictable. That is when I shifted my focus from how much can I make to how much can I lose. It sounds simple, but it changes everything when you look at a trade through the lens of risk first. You stop chasing subpar setups. You stop trying to force a trade when the market is choppy. You see, I want to know that even if I'm wrong 5 times in a row, my account will still be alive tomorrow. That is the goal. Survival first, profit second. Because if you run out of chips, you can't play the game. And the only way to ensure that you never run out of chips is to have a mathematical, non negotiable risk plan. So let's break down the actual plan. This is a safety net that I use every single day. It consists of 3 non negotiable rules. The first one is a max loss. The second one is position sizing. And lastly, using a technical stop. Let's talk about rule number 1. You see, I have a maximum dollar amount that I'm allowed to lose in a single day. Once that number is hit, I am done. The platform gets closed. No revenge trading, no trying to make it back. For me, this number is set at a level where it hurts enough to be annoying, but not enough to ruin my week. You got to think, if you lose 10% of your account in one day, then you'd need an 11% gain the next day just to break even. Or what if you lost 50% of your account? You would need 100% gain just to break even. And that is when the math starts working against you. My hard stop ensures I never dig a hole so deep that I can't climb out of it. Rule number 2, position sizing. I used to vary my size based on how confident I felt, but that's a trap. You see, your confidence has zero correlation with the market's outcome. Now I risk the exact same amount on every single trade. This creates consistency. If I take a loss, it's just a standard business expense. It doesn't wreck my emotional state because I know exactly what it costs before I enter. I want to know that one bad trade cannot wipe out 3 good ones. By keeping my sizing consistent, I let the probabilities play out in my favor over time. All right, rule number 3, my stop is based on a technical level. I never place a stop loss based on a dollar amount alone. I place it based on the chart. That is when I look at support and resistance levels. If the market breaks a key technical level, the reason for the trade is invalid. You see, if you place a stop just because you don't want to lose more than $50, the market doesn't care. It will sweep your stop and reverse. You have to place your stop where the trade thesis is proven wrong. And if your stop causes you to have a risk that is bigger than what your reward is, hey, I simply won't take the trade. Okay? That is the 3 key rules and my safety net. Implementing this plan didn't fix my account overnight. It took time. It was a slow, boring grind back to break even. But you see, that boredom was my salvation. Slowly, the equity curve started to point up. Not because I found a magic indicator, because I stopped bleeding out. I got my trading mindset right. I stopped having those catastrophic days or catastrophic weeks that would erase weeks or months of profits. That was the key that turned my trading around. If you're struggling right now, if you feel like you're one bad trade away from quitting, I want you to stop. I want you to take a step back. You don't need to trade today. You need to build your safety net. Write down your rules. Define your max loss. Know what your position size should be. Know where your technical levels are that would stop you out of a trade, and make sure you have a plan for every single trade. Also, respect the trend of the market. The market will always be there, but your capital won't be if you don't protect it. That's when you become a professional. If you found value in this video, make sure you're subscribed to get more structured trading education. And be sure and like the video as well. I'm very excited to announce that my trading partner, Trendy John, and I will be hosting a free webinar in March 11th. There will be a link in the comments below for you to sign up for that webinar. In the webinar, we're going to be talking all about our new and exciting upcoming class where we are teaching how we find supply and demand levels that allow us to be on the same side of a trade as the big money. I look forward to seeing you in the next video.